If someone had told me 5 years ago, join this live trading session and make easy money out of the markets, I would have said, what's the catch? How much does it cost? But here's the thing, what I do is 100% free. I don't charge you for anything. You're welcome to join for free and smash the markets with me. And I'm not just a random guy on the internet. I've been interviewed by prop firms, I had dozens of payouts, and the numbers just don't lie. So, if you not only want to make money, but also learn while I'm analyzing the charts, then join the Discord in the description. It's free and you have nothing to lose. See you there. I like to personally look at the monthly chart. Now, I'm not looking into the monthly chart every single day. I'm only looking into the monthly chart once or twice a month, right? Especially when the month is just starting, I like to look at it. Now, judging from this monthly candle alone, it might seem off as like an exception that we're not going for the high, but we're also not going for the low. Judging from the logical daily bias perspective video that I have made, because it applies to every time frame for that matter, but it is the most reliable on the daily and on the weekly. On monthly is kind of weird a little bit if you want it like that. However, based on just that logic alone, so ignore everything that happened before, right? Try to only see those two candles right now. So this candle and this one, it looks like it would go for the low, but we have a very strong counter argument, which is this entire gap right here. And I've explained this previously as well. In the chart, especially the higher you go with the time frame, it becomes more and more less likely to not fill the price gaps. So an actual price gap, not just a fair value gap for that matter, like an actual price gap. It rarely does not get filled with a body closure. And if you go back to the chart, there will be exceptions. Of course, there's always exceptions because nothing works 100% of the time for that matter. But in that sense, most of the time it will get it. So what will happen, even if it's not this month, right? Although this month is very, very strong. Why? The reason for that is because this body closure barely touched into the entire gap that we have just drawn out. So what do you think the next is going to do? It will have a body closure above it. There's the entire logic behind the monthly time frame, and also why the entire intuition today is going for longs. Now, after we have understood that, let's go into the weekly. Quickly, we will go over the entire weekly chart. So what did happen, or for that matter, what have I just told you? Gaps always get filled, not just with a weak close. So this would have been, for some people, right? For some people, this is already enough because we have basically filled up the entire gap with a weak close. But in my way of trading, and actually factually wise, not just because I'm saying that, go back on the chart and check it out for yourself. We love to take out these gaps, but with an entire body closure. So we are waiting for that. Even if it's going lower, we are still waiting for that, and eventually it will happen. Now, of course, you couldn't really predict it just based off the weekly chart alone that this will go for the downside, but there is a big hint for that, which is we have relative equal lows. Now you might say, but there's also relative equal highs. But there's another but. If you go back in time, at that time we did not really have relative equal highs to begin with. Now you could say that those are relative equal highs, but on the weekly it's not. If you go into the daily, those will be relative equal highs, but just based off that we went lower, and from that point on your bias would already be short. Now this only confirms the movement to the downside more once this trades even more, because then we are creating very clean relative equal lows. Now in this specific candle, in this moment of time, even I would have thought, okay, the weekly candle will go for the relative equal highs, right? We keep on skipping forward a little bit. And also this is another very rare price action occurrence that it did not go for the high more than that, especially because those are relative equal highs onto the daily chart. So it was kind of a rare occurrence, but overall the trend is still going for the relative equal lows, and the next thing what will happen will go for the relative equal highs. Now this is of course hindsight, but I'm explaining this because this will make a lot of sense in our current analysis that we're looking out for. and then went for the low. So where is it going to go next? It's going for the high, because now we took out fuel basically to go higher now. Now I will skip forward a little bit because the logic for that sense is now complete. So after we have understood that for the weekly chart, we now go on to the daily, and now we're already at the present basically. So here's another thing, or actually two things, just based off the daily chart. What have we just talked about? It is that gaps get filled with a body closure, right? We have a price gap right in here. So what is going to happen next? We will fill it out with a body closure. But also the next thing that we have is that FVGs as a whole. Now, if you would ask me what is a better ranking, right, on a scale from 1 to 10, are price gaps like these are more reliable, or FVGs? Because let me first explain the thing about FVGs. FVGs also get filled, or at least traded into. Now, the thing about FVGs is they don't get body filled. That is not a requirement as a whole, right? It also happens, but this is not a requirement of trading them. Once it has just tapped with a wick in there, sometimes you could even say, okay, that FVG is not even valid to me as a confirmation point. So if you would ask me what is better, a gap or an FVG, I would always say it's a gap. A gap is way more reliable. So we have these two things that are basically saying we will go to the upside again, right? We have too strong of a magnitude for that not to happen. Now if we go to the 4 hour, you can see that we had quite of a clean, let me remove that. We had quite of a clean price action right here. We had relative equal highs, traded back into them. Now in this way of trading, by logic, right, you wouldn't be wrong if you said that, well, we traded into the relative equal highs, now we will go for the lows again. And if you would have thought that, then that is completely right. That is completely right. But looking at the long-term perspective, even though this went to the downside and even took out this low, I still knew that this will go higher again, because there's just too much to judge off about that this will go higher. Now we have this big fair value gap right in here. I have just told you that FVGs, once they get filled just with a wick, it doesn't have to be entirely. Most of the time you can screw them. This is an exception because this is a very big fair value gap, and when it comes to magnets, right, then a small fair value gap is not necessarily worse than a big one. But in this case specifically, the fact that this candle, I want you to pay attention to this candle and also to the gap combined with the entire gap on the daily chart, because it's on the 4 hour chart, it looks like it got filled, but the daily chart, it did not get filled with a body. This candle specifically, the way it traded into it and then immediately pushed back lower, is a very rare occurrence. It doesn't happen that often that it looks like this, because this is, some call it a doji candle or something like this. Basically when a candle doesn't have a body or barely closed above or below its opening price. And this alone is a very rare occurrence. Go back into the chart and check it out for yourself. When something like this happens, we love to push for the high or for that low of this specific candle if it happens like this. Now if this candle would be at the high of these entire highs, this would be a different story, right? So you can't compare it like that. You have to have this specific framework. And they say, well, how do I get this? This comes from hundreds of hours of experience just watching the chart and memorizing them. Sometimes it's not even about noting the stuff out, but it's just about recognizing the patterns because you have seen it so many times. Okay? So again, although short-termly this was going for the downside and you were right on that, but for a little bit of a more long-term perspective, this will go higher again. So the 4 hour chart right now, I will remove the daily gap for now and also the FVG so the things don't get messed up too much. So we have a clean chart. So now what do we have? We have this big 4 hour close, and this is as we have just talked about, a doji candle. And this would be looking like this will go lower, right? And initially it can, even though this FVG got filled, even with just a little bit, but it got filled, this still holds weight because in order to go higher, we need to go lower first. So an occurrence like this is definitely possible, right? Or even trading looking at it from a 1 hour perspective. Now just imagine this is a 1 hour chart. Trading into it, getting a little bit higher, taking out this low, and then going higher. Classic example, right? However, it doesn't really matter for now because this framework alone is already all we need. So this is the target for today that we are looking out for. And so some just take this alone. I'm going to mark it out because this will probably stay for the entire analysis. Those relative equal highs, so for some, this looks like, okay, I'm just going to long the shit out of it and we'll go to the upside. And I don't care about anything you have ever said before and, you know, just give me the relative equal highs, I'll trade into it. But they don't understand that if you just trade the relative equal highs on their own, then this is not going to work. You need an entire framework, right? What have we just talked about as a very quick summary? We have talked about the monthly chart, we have talked about the weekly chart, how the relative equal highs and lows impact the price, how and the reason why it was bouncing off of the high and the low. We've gone onto the daily chart, explained the gaps further, also in the weekly chart, right? And although we have still arguments to go for the downside, such as this FEG, the pros that speak for longing today are way more than the pros for shorting today. So we have built an entire framework. It's not just the relative equal highs, but it's so much more that plays into it. I'm not just trading the relative equal highs because I've also seen it in Discord, right? In our own Discord server where people just see relative equal highs and they just ask me, are those relative equal highs? Can I long in there? Well, yes, those are maybe relative equal highs, but don't you want to forget the entire framework that we're talking about, going on to the lower time frames like the monthly, weekly, and daily, and building off a framework? And the next thing I also want to mention is don't take relative equal highs or lows from the 5-minute, 15-minute chart. Now 50-minute can be okay, but anything below that, don't take it. It's not reliable, right? We say that the market is fractal, and it is fractal, but only to a specific amount of extent. You see that on the daily chart, things are more reliable than on the 1-minute chart. That is a thing on itself. The market is fractal, but it is not 100% fractal. If you go onto the 1-minute chart, the candlestick patterns look way different. Just as a quick example, right? You see that all of these have wicks. Most of them. We have outliers like this, but most of them have wicks. If I go to the 1-minute chart, way more candles don't have wicks. Now you say, well, of course, this is the 1-minute chart. We have more frequency of candles to begin with, but this is a wrong argument on itself. Because although, of course, we have more frequency, but if you compare to for pound for pound, if you get what I mean by pound for pound, I mean, let's just take 100 candles of the daily chart and let's take 100 candles of the 1-minute chart. The fact that this candle and this one don't have wicks, so this one doesn't have one to the upside and this one doesn't have to the downside, this will more happen on the 1-minute chart. So this is my sort of proof of concept that the market is fractal, but it is not 100% fractal. So you should not just completely rely on that, say, okay, relative equal highs work on the daily, so I might just trade them on the 1-second chart, right? Because it's not 100% fractal. The concepts do work, such as we have a gap right in here. It got traded into, fully with the body closed. But even though this is presenting itself right now on the chart, I don't rely on that because it's the 1-minute chart. And I rarely ever look on the 1-minute chart. Rarely. So again, what kind of framework have we put out for ourselves? In a very quick summary, we have to analyze the monthly chart, more likely to go to the upside because of the gap. We have the weekly chart, also more likely to go to the upside because of another gap. We have the daily and 4-hour, and I also want to quickly mention the 1-hour chart. So this is the target for today. But the entire framework actually starts right in here because we have another relative equal high right in there. Now you might say, this is not a relative equal high. How can this be a relative equal high? Because a relative equal high has to be a swing high and another swing high relatively equal close to it, right? This would be a confirmed relative equal high if it will be looking like this. But in here, we don't have a swing high that is suggesting that we have 1, 2 swing highs, okay, relative equal highs. But if we go into the 50-minute, that's why I'm saying on a 50-minute, it is okay, but it has to be in the context, not just random. Now, this specific candle, isn't it? Just draw it into here, and now you have your relative equal highs. So this is why I'm referring that as relative equal highs. Don't get confused about it. So we have even more proof. Now, in this combination, right? So sometimes, let's just assume, let's have a very quick ranking. Let's just assume that the gaps that I've just told you about, that they always get filled with a body closure, are the number 1, right? But then let's just say FEGs are the number 2 and relative equal highs are the number 3. But here's the thing, sometimes concepts, when they are combined, such as here, we have the relative equal highs, but also the FEG. A combination can sometimes be more quality than just the other concept on itself. So I'm talking about the gap. Because this combination is very strong. Go back into the chart and check it out for yourself. Having this kind of combination, relative equal highs, but also combined with an FEG. So not that only, let's just say we have an FEG right in here, right? This will be, again, something different. So you understand this is a little bit more complex. It is simple, but it's a little bit more complex than you would think of at the start. So if we would be looking like this, the FEG is in here and the relative equal highs are here, this is already a different story, different framework. So I already don't see this as high of a quality as if we have something like this perfectly aligning. Not even perfectly aligning, but they're a part of the same thing. Okay? So again, our framework for today are those relative equal highs. I kept them on here. Combined with everything we have just talked about, I want to quickly mention that a very classic scenario is tap either. So this is the 4-hour fair value gap. This is the 1 hour. Do something like this. Tap into the 4-hour. Violate the 4-hour. Go into the 1 hour. And then just shoot up to the relative equal highs. This is exactly where we are literally just going to take up our tool. Stop loss. The take profit for the relative equal highs. And the stop loss below all of those lows. This will be fine. Now, personally, I am not going to do the stop loss below those lows. I like to give it way more room than that. So I'm going to orientate myself onto the left of the chart. I'm going to do a 4-hour for now. There's not much to orient about, but what I see, for example, is we had an FEG right in here. So I see this a little bit as a protective high. As a protective low. I'm sorry. So this is why my stop loss will be right in there. So completely below it, right? Now, safe to say that this stop loss will most likely also already work. But for me personally, I have a different approach to this. So it's going to be, for me, way lower. And you can take this trade and you will make money out of it. Here's the alternative that you can also take. You can wait until it gets to the 1 hour. Very likely thing to happen, right? Especially if you're a beginner watching this, this will be the first thing that you will be looking out for, just so you don't have that much of an aggressive entry. But of course, you can just take the aggressive entry with me. It's safe to say. If you want even more risk to reward, you can go for the 4-hour, but this is less likely to happen. Now the 1 hour, very likely to happen. Most definitely it will actually happen, but I have a very aggressive trading style when it comes to something like this, because I'm just very sure of the setup. So I am for the upside, and this will go higher, and you will make money out of this. And as always, for everybody that is just coming in for the results, it's no problem. I'm just telling you, you're not learning anything out of this if you're just looking out for the results. But here they are. As you can see, everything that I've predicted earlier actually happened. Because this way of trading works, and everybody who denies that is denying the facts of the markets. Numbers don't lie. And guys, see you in the next one.